Hello, folks. Brandon Chapman with you today. It's another edition of the Monday video for TheoTrade. It's October 14th, and of course, it's Columbus Day. So, again, celebrating the discovery of America for the West. But anyway, it's a great opportunity to think of our heritage. Many people came over following that. But anyway, I digress. Today, we're talking about the market, and what we're talking about specifically is welcome to the pain trade. And you're thinking, well, the market's up 0.82%. Why is that the pain trade? It's because the pain trade is delivering the maximum amount of pain to as many people as possible. And one thing we had going into this little squeeze here is that a lot of hedge funds were short. There's a lot of shorting in the market, right? Bearish attitude. And certainly I thought, for example, I think we'd probably rip lower from this high. Instead, we quickly gathered and rallied, despite the fact that if we look at Treasury yields, you think about the maximum amount of pain. Was any of this movement precipitated by Fed cuts? And yet, look what bond yields have done. They've continued to move higher, although backed off its highs intraday today. We'll come back to TLT. But as you go back to the SPY, you'll see, man, at the beginning of September, we've seen the market rally in the face of very quickly and substantial rise in long-term Treasury yields. In the meantime, the Fed is expected to cut. But now, all of a sudden, we're kind of pulling back on those expectations. So we're wondering what's left for the market to do. And so the pain trade at this stage is a slow grind to the upside. Now, you may say 0.82% is not a slow grind, but we're talking about just the endless just kind of grind day after day. And the unsatisfaction that you probably experience from this is that it's isolated into very few companies. As we look here, XLK, XLF, XLI, we've got technology, financials, industrials. Those are the only three sectors that are outperforming the S&P 500 now. If you picked anything else, you're now underperforming. We look at it over the course of the last week. Again, S&P's right here, isn't it? We look at it for today. I guess they should order this. Only utilities and technology today outperform the S&P 500. Everywhere else you chose, you did not experience the same level of satisfaction as those that own utilities or technology or the S&P 500. And that also is painful, right? To watch the market go higher and realizing that you're not participating fully in the market's rally. Why? Because it's in a handful of stocks. You look over your Qualcomm of 4.7% today. That's a big move. Why? Why is Qualcomm breaking out today? We had the earnings. The earnings didn't really produce a whole lot. They've got earnings coming up here in a couple weeks or a few weeks. Why today? Why is it picked today? We're seeing the breakout. Again, the pain trade, what we have is basically those we're short are having to cover. And I'm not saying necessarily that Qualcomm's one of the stocks they're covering, but NVIDIA's continue to grind higher. But then you got Wells Fargo in here. Wells Fargo, you had banks over the last few days that have announced earnings. We had a big move in Wells Fargo. We had a big move in JP Morgan on Friday. And yet JP Morgan, they made their money on what? Net interest income. So the Fed has cut rates in order to steepen the yield curve, push up long-term yields, and it's benefiting banks. Great. So we get paid less in our money in our bank account, our savings account, and we pay more if we borrow money. That's improving their margins at JP Morgan and other banks. We got Bank of New York Mellon. Okay, this is a regional bank, continue to run despite the losses in the Treasury market. It's crazy. So go through this list, you find a hodgepodge of different companies, many of which that have had pretty negative news over the last couple of months via earnings or other announcements here. Again, we got all this stuff going on. Nextera broke out. We're running back again towards resistance. CVS has done okay, grinding it out, but very extreme here in the near term. And so when we kind of put this in perspective, we're saying, look, how much can the market continue to grind higher? We're going to talk about how to be able to see that or anticipate that, because when we look at the VIX has remained stubbornly high. And I've kind of looked at that and said, well, yeah, if the VIX is high, the perceived risk in the market is there still, right? We're expecting a lot of movement, and we're seeing that reflected in skew. Skew yesterday or Friday ticked up to 159 from down here at about 154. We're seeing rising and an already high skew, which means what? The default trade in the market is for it to move higher until the tail risk is established or realized in the market. But when we look at the VIX, what we see is that there's still room for the VIX to decline. So the question was, do we hold up here at around 20% through the election, figure it out, or is this the beginning of a slow grind downward in volatility? Maybe starting slowly and then even dropping more quickly. And it's the way that I like to look at this is from a ratio of 3-month volatility to 1 month. And I'm saying, what's the ratio of 3-month volatility to 1 month right here? This is the yellow line. Well, what do you see here? Well, recently, again, we talked about how it escalated so quickly and got down here. On the 7th, we dropped below 1, which means what? We saw that 3-month volatility dropped below 30-day volatility. And that's usually a sign, hey, we may have reached a bottom in the market. But it happened so quickly with very little pullback. Now what do we see? Well, the opportunity for this line to rise as the VIX is sold and the 3-month volatility does not drop as fast, this may steadily rise or quickly rise back above 1.2. And so while we have room to the downside in the VIX, while we have room for this to rise as the 3-month to 1-month volatility ratio is really low, when you look at skew is already at very significant and very high levels. So we'll get shortly what skew is for today, but the idea is we may see this tick up. So for me, this is kind of the canary in the coal mine. Okay, if suddenly skew starts to decline, the hedges are being taken off, the VIX is being sold, maybe we are setting up for a run here in the market. If not, what we'll be looking for is the VIX to decline and skew to rise back towards record levels again. And in that circumstance, what are we really assessing? That the market has limited amount of upside until the VIX runs out of downside. And at that point in time, relative to 3-month volatility, when it gets back above 1.2, at that point in time, we're going to start to really assess the downside possibilities here. And so while the market could definitely fall apart tomorrow or the next day, there's lots of swans out there in the water that could really drop this thing. But if we're looking at it, if we proceed normally, we'll see this continue to rise until we reach kind of a crescendo or an apex here in 3-month volatility. And at that point, we got to really assess the downside risks. But how do we assess the risks of skew? Skew's already elevated. It's a 159 right now. This just says keep some powder dry, right? You may look to hedge in particular if the volatility continues to decline back towards 15. The fact is, as we look at this last week and we see financials was the second best performing sector, how is that possible, right? How is like JP Morgan or US Bank, these more lending focused companies, Huntington Bank has earnings coming up shortly. We'll see what kind of determination what they're going to produce. But KRE, this is a regional bank ETF, up strong in the last couple of days. While Treasury yields have risen and bonds have been selling off, prices going down, unrealized losses of these regional banks have increased. Now, the federal government through the Treasury had previously talked about refunding, basically issuing debt and using some of that debt to buy back some of their bonds from banks. It was a bailout. We will find out to what degree, but there's very little transparency here. Do we really feel the prospects for regional banks in the wake of defaults or delinquencies in credit card debt and other appetites for debt starting to struggle right now? Or do we say, look, this is kind of a short term. Yes, profitability is a little bit higher, but it's the balance sheet, stupid. Okay. It's the balance sheet that may carry these down. So luckily we'll probably see the result. We have highs, we have lows. Which direction does it break out? Now I can show you for XLF, there was a significant trade today in XLF on the downside. And in this case, we're looking at 1 November. So we'll come here 1 November right here, 35,000 contracts, 46, 44.50. This is sizable interest coming in here today, buying this downside vertical spread with the expectation of 44.50 in 18 days or less. 44.50 is basically back here at prior lows. The point being is that we're seeing a significant sizable trade coming into the market that's suggesting that we may have reached an apex here in XLF. While I agree with it, it may take a little bit. We may grind higher before we go lower. And that's the pain trade, right? Going against you in the near term. But here is one indication and a relatively cheap spread to boot. We're looking at, 36 cent cost here. They got something out of that one. But point being is that a downside vertical spread looking at 44.5 for recent lows, but we may move significantly below that. Now, as we look at TLT, we're looking at treasuries. Well, yields have risen as prices on TLT have declined. We're basically right now, we're approaching the 61% retracement of the rally we saw based on rate cuts from April through August into early September. Now, are we poised to see a bit of an upside move in TLT? In fact, if I bring up something called, it's going to get busy here, but if I bring up the pairs ratio or auto expected move, what you'll see is we were below the expected move, at the expected move, over 2 times below the expected move last week, and here we stand today. Okay, so basically every single week we've touched the lower expected move or closed below it or significantly below it. This certainly seems like a reasonable time to start to look at the upside in Treasury prices, at least for a near-term bounce in TLT. Now, the question is, how far do we get? If the market begins to sell off, is there more of a rotation towards treasuries and more of a bid in the treasury market versus the stock market? And also we start to see SPY roll back. We might start to see, bonds start to just kind of hold their own for a little bit while we continue to grind higher and volatility continues to fall, or we entirely reverse from this level. But the pain trade right now is the market continues to grind and bonds continue to sell until eventually we start to see that reversal and we start to see the market come in. As we look at gold to find some sort of clue, one of the things that gold's done well is it's not experienced a significant sell-off as treasury yields have risen. As bond prices go down, generally you see weakness in gold prices. But we're not seeing is real dollar strength playing out. Yes, we're seeing selling in the bond market, but we're not seeing dollar strength to really drive down gold prices. And as a result, we are seeing dollar strength vis-a-vis other foreign currencies. So it may attract some dollar flows into our treasury market. But the fact of the matter is, liquidities continue to expand. The Fed has not done a lot. They've certainly cut rates. They've not done a lot to reduce the size of their balance sheet and to tighten up credit conditions. And so again, as the dollar continues to run here on the prospect the Fed's not going to cut as much, we're not seeing real intrinsic strength in the dollar that would cause gold to go to decline. Now, the threat here is what happens if the dollar begins to weaken, right? Materially, not just in real terms and relative terms, in which case gold may go significantly higher, but that may help hold up the market. The downside in the gold market is if the dollar begins to strengthen as the financial sector really start to recognize some of the real issues that exist in the financial sector, and we start to see broader declines in the market, scrambling for dollars, paying off debt. In that case, treasury yields dropping, prices rallying, gold likely in that scenario dropping. But the fact of the matter is, oil right now is coiling in, and we'll see what it can produce. It ended near low, say 5%. We've not taken out yet the low from October 9th. We're testing old resistance going back to September. Can oil prices stabilize and begin to rally? Energy sector was only down 0.04% today. It's holding up in here so far. We're going to get inventory data and other indications as far as oil supply, but we already know the oil market is undersupplied. And if we look at the graph here, we are in backwardation. There's an implied shortage in the oil market. We're kind of struggling here in the energy sector, but holding. Meanwhile, oil prices decline today. Again, it doesn't make sense that it would be such a boost for oil stocks. But let's be honest. Again, we've had some volatility here. We're seeing selling. We're back at support. We'll see if we can hang on to $72 or about where we're at right now. As we look at utilities making a nice move today. Again, have kind of dropped a bit. We kind of ran. We had another nice day today in utilities. How can it continue to do that if yields continue to remain near highs? Again, drop in energy prices today. Oil certainly have helped them. But again, these are usually move opposite. Yields, as yields rise, usually this creates more pressure in utilities. Right now, we're rising in the face of it. Is the utilities market anticipating that yields will start to come down? Or are they just getting ahead of themselves? We're just seeing some defensive rotations. Again, we'll see what happens. The pain trade, though, is that yields continue to grind higher along with the S&P 500. The VIX just basically, the VIX selling just causing the VIX to decline and helping to drive equity prices higher, led by the likes of NVIDIA. We walked through today a spread in NVIDIA trying to capitalize on upside potential here, assuming that if the market continues to go higher, NVIDIA will go with it. The bearish trade today is, of course, looking at an XLF and thinking about the possibilities here as we had a big breakout, but recognizing the broader concern. And the fact is that the inflation problem of long-term yields rising may cause pressure as some of those unrealized losses mount, and the recognition of their balance sheet, whether it's commercial real estate or other types of loans that may start to see a breaking point here. Because at this point, we're not really seeing a lot of directionality and strength, or at least strength that can be maintained. Yes, NVIDIA's continue to rise. Okay, yes, some of these stocks have risen. This is why it's painful. Were you in them? I think for many, no. But households are at a significant percentage of their wealth is in the stock market. At least as of a month ago, it was over 57%, near a record high. So again, we're fully allocated in the household sector. Hedge funds are covering right now, creating a painful situation, and we're not seeing a lot of breadth to the rally, at least in the last week, as we see only 3 sectors are outperforming the S&P 500, and a couple of them are straggling and they're down today. All right, folks, wrap it up there. But again, we'll have to see how this pain trade plays out. Watch the VIX. VIX selling may help continue to drive prices higher till we reach that climax that we talked about at the beginning of this video.